The global energy landscape experienced a significant jolt in early 2025, a year that will be remembered for its seismic shifts in the oil industry. After years of ascendancy, U.S. oil exports witnessed an abrupt contraction, a phenomenon that few had anticipated. This unexpected downturn has sent ripples of concern across international markets, causing a flurry of activity among traders and analysts alike. The era of seemingly limitless American shale oil has been sharply interrupted, leaving many to wonder about the future of this once booming industry. This change was not widely predicted, catching many by surprise and leading to a scramble for answers. The sudden scarcity of U.S. crude oil raised pressing questions about global energy security, prompting urgent discussions among policymakers. Nations accustomed to reliable American supplies are now reassessing their energy strategies, seeking new alliances and sources. The stability that American exports brought to the market suddenly appeared less certain, casting a shadow over future projections. This has created a palpable sense of unease, forcing a re-evaluation of supply chains and logistics on a global scale. The primary beneficiaries of this slump appear to be Russia and China, who are now stepping in to fill the void left by the U.S. for U.S. allies. Increased reliance on these powers presents new challenges, both politically and economically. This essay will delve into the circumstances that precipitated this crash in U.S. oil exports, examining the underlying factors and key events. It will explore the economic and political motivations compelling American allies to turn towards Russia and China, and the broader implications of these shifts. Furthermore, we will analyze the profound impact of this shift on the global oil market. Considering both short-term disruptions and long-term trends, the story is still unfolding and its full ramifications are yet to be seen. The decline in U.S. oil exports in early 2025 stemmed from several critical factors. This downturn was not a result of a single issue, but rather a confluence of multiple challenges that hit the industry simultaneously. One significant element was an unexpected policy re-evaluation within the U.S. The government decided to reassess its stance on energy exports, leading to a shift in priorities. New regulations prioritized domestic energy security, limiting export licenses. This move was aimed at ensuring that the U.S. had enough energy resources to meet its own needs first. Compounding these shifts were severe disruptions to critical export infrastructure. Natural disasters and technical failures played a significant role in hampering export capabilities. The Gulf Coast export terminals suffered a cyber attack and an early hurricane season. These events caused significant damage and delays. These events created bottlenecks, reducing the capacity to export crude oil. The congestion at ports further exacerbated the situation. Furthermore, underinvestment in new drilling within the U.S. shale sector became apparent. The lack of new projects meant that production levels could not keep up with demand. The capital discipline urged by investors slowed the pace of bringing new production online. Investors were cautious, preferring to see returns on existing investments rather than funding new ventures. The cumulative impact of these changes created a perfect storm. The industry faced multiple challenges that compounded each other, making recovery difficult. By spring 2025, U.S. oil available to the global market had dwindled significantly. The reduction in supply was felt worldwide. This sharp contraction left international buyers scrambling. Countries that relied on U.S. oil had to quickly find alternative sources. It fundamentally altered the short-term calculus of global oil supply. The market had to adjust to a new reality, with ripple effects felt across the globe. The primary driver for U.S. allies exploring alternative energy sources is energy security. With the global energy landscape shifting rapidly, nations are increasingly aware of the vulnerabilities tied to over-reliance on a single source. The abrupt downturn in American oil exports has shaken this confidence profoundly. This has led to a re-evaluation of energy strategies and a push towards more resilient and diversified energy portfolios. Nations that had diversified towards the U.S. now need to diversify again. This time the focus is on creating a more balanced and secure energy mix that can withstand global market fluctuations. This search is driven by the need to ensure their economies can function without disruption. Energy is the lifeblood of modern economies, and any instability can have far-reaching consequences. Economic considerations also play a crucial role in this strategic pivot. Countries are not only looking for stable energy supplies but also for cost-effective solutions that can support long-term economic growth. The reduction in U.S. crude has led to increased price volatility. This unpredictability in the market has made it clear that relying on a single source is no longer viable. Allies are seeking more affordable and stable long-term contracts. They are engaging in negotiations to secure energy deals that offer both reliability and economic benefits. This includes engaging with suppliers who might offer more favorable terms. By diversifying their energy sources, they aim to mitigate risks and ensure a steady supply. Beyond the immediate trigger, there is strategic wisdom in diversifying energy imports. Renewable energy sources like wind and solar are becoming increasingly attractive as part of this diversified approach. The recent American situation has served as a stark reminder of this principle. It underscores the importance of having a robust and flexible energy strategy. Many countries were already cultivating a broader portfolio of energy relationships. This proactive approach is now being accelerated in response to current challenges. The current circumstances have accelerated this trend. Investments in infrastructure and new energy projects are being fast-tracked to meet future demands. Some countries require particular grades of crude oil, prompting them to seek out suppliers like Russia. This adds another layer of complexity to the global energy market. This complex interplay of needs and availabilities is redrawing energy relationships. The global energy map is being redefined as countries navigate these new dynamics. Russia has long been a formidable force in global energy markets. Even before the recent contraction in U.S. exports, Russia had reoriented its energy flows eastward. This strategic pivot was driven by geopolitical factors and Western sanctions. Key to this resilience has been strong energy ties with China and India. These nations have provided Russia with stable markets for its crude oil. Russia has proven adept at ensuring its energy products reach international buyers. The sudden shortfall in U.S. oil exports has created a significant market opportunity for Russia. For countries now scrambling to secure alternative supplies, Russian oil presents an available option. This dynamic allows Moscow to enhance its influence in global energy markets. China's role in the global energy equation is immense. As the world's largest importer of crude oil, China's purchasing decisions impact prices and trade flows. This necessitates a proactive energy security strategy, compelling Beijing to secure resources globally. A core component of China's strategy is diversification. Beijing has cultivated strong energy relationships with Russia, Middle Eastern producers, and others. This network of suppliers provides China with a buffer against market volatility. Beyond consumption, China is a significant investor in energy projects worldwide. This financial clout allows China to secure future energy supplies and influence host nations' energy policies. In the context of the U.S. export downturn, U.S. allies might engage with China in new ways. Understanding China's energy moves is critical for energy importing allies of the United States. The reduction in U.S. oil exports has tightened global supply. This places upward pressure on crude oil prices worldwide. Consumers globally feel this impact at the petrol pump and in the cost of goods. A significant consequence is the rerouting of global oil trade flows. Traditional shipping routes are being altered, intensifying eastward flows. This necessitates adjustments in tanker availability and port capacities. The response of OPEC+ to this new market dynamic will be critically important. They could increase production quotas to stabilize the market or benefit from higher prices. The global oil market has been plunged into increased uncertainty. This environment demands greater agility and foresight to navigate effectively. The contraction of its oil exports presents a significant geopolitical quandary for the U.S. America's status as a major energy exporter had become a potent tool of its foreign policy. This energy dominance narrative provided Washington with considerable leverage. The sudden inability to sustain these export levels diminishes this aspect of American soft power. Economically, the repercussions for the U.S. are substantial. The loss of significant export revenues will negatively impact the nation's trade balance. The situation risks straining relationships with key U.S. allies. Nations that relied on American energy supplies may now feel exposed. This could lead to a reassessment of the reliability of the U.S. as a partner. A diminished role for U.S. oil in global trade could challenge the preeminence of the U.S. dollar. The shift in U.S. oil export capacity is reshaping the global geopolitical chessboard. Nations traditionally aligned with the U.S. must navigate securing energy supplies while managing commitments to Washington. This may lead to more nuanced foreign policy stances. The evolving landscape may strengthen alternative international blocs. Countries like India and Turkey might see their independent foreign policy approaches validated. A tighter global energy market increases the potential for competition over resources. Nations may become more assertive in protecting their energy interests. This underscores the link between energy security and geopolitical stability. The U.S. export downturn is accelerating the emergence of a more multipolar energy world. This shift means that power is more diffuse, and alliances are subject to more frequent re-evaluation. The early months of 2025 have marked a pivotal moment in global energy. The contraction in U.S. oil exports has sent shockwaves through the international system. The old certainties regarding American energy abundance have been undermined. This change has forced a reassessment of global energy supply chains. For U.S. allies, this presents a formidable long-term challenge. Securing reliable, affordable, and sustainable energy supplies is now more complex. This will necessitate nimble diplomacy and a focus on domestic energy efficiency. The pursuit of energy security will shape foreign policies and international partnerships. This episode underscores the importance of energy in international relations. The U.S. oil export crash of 2025 will be remembered as a significant inflection point.